Hey, hi there. It's Neil Christiansen, and welcome back to another episode of the Mile High Market Talk podcast, where we bring local professionals to the stage and have them share their expertise and educate those who are looking to grow their overall net worth. In today's episode, our guest is Pete Pittman, and he is with Aspen Leaf Wealth Management. He's been a planner for many, many years here in the Denver area, and he loves to sit down with folks one-on-one to discuss their plan or even put a plan in front of them, not just the equity position, but he likes to bring the house into the plan as well so that going forward, they have a really good understanding of how they're going to be able to live comfortably in retirement. So a great guy to have those conversations with. But without further ado, Pete, how's it going today?
Great, Neil. Thanks for having me.
Absolutely. Absolutely.
Happy to be here.
Good, good. All right. So what we're going to discuss today is I put out a newsletter and the title of it was something to the fact of, is it best to have a house free and clear? The open rate was significant, had a lot of conversation about it. So I thought, why not we discuss a little bit more about that? Bring an expert in particular from a financial standpoint, and have a conversation about, is that the right thing to do? It's not to say that it isn't. It feels probably pretty good to have your mortgage paid off in full, but is that from an emotional standpoint or from a strategic standpoint? So what we're going to do is discuss that today. And a stat that I wanted to share with you is, right here in the Denver metro area, 27% of homeowners are actually free and clear with their mortgage. And this is the highest on record to date. So that's why we also wanted to kind of bring this to the table, is there's a lot of folks out there that have a free and clear home, but are they truly prepared for retirement? So that's what Pete and I are going to discuss today. So Pete, let's dive right in. My first question to you is, I get this question all the time. I have a ton of people coming to me and say, hey, how do I get rid of this mortgage? What can I do? Whether it's just a recent purchase or someone that we've been in contact with for many, many years. They want to try to eliminate, reduce, whatever it is that they can do. And sure, we've got strategies and so forth to discuss. But the question is there's a fine line, I think, with one wanting to eliminate that mortgage completely because they're having to probably put additional principal cash towards it. There's a fine line to smart debt elimination and what I would call a financial tunnel vision, meaning that they're just focused on getting that house paid off and forgetting about all of the other opportunities that they might be missing. So, Pete, let's have that conversation, or at least address that question. What does that fine line look like?
Yeah, it's a great question, Neil. And I think the first thing I always think of with this is, or the first thing that comes to mind is, it always depends. It depends. And with everything,
You sound like a
trade-off.
CPA. Pete, you sound like a CPA.
Or a CFP.
Or a CFP, sure.
Yeah. Every conversation, we always say that, well, there are trade-offs here. Yeah, this may work, but there's no perfect strategy for anything. And it always depends. And I always start with what is rational versus what is reasonable. And for the most part, people usually pursue the reasonable option, which is based on their past experiences and their life and their emotional, decisions, all related to money, are very reasonable decisions to them. Even when a CFP or a CPA or some expert comes in with, here's the rational thing, here's what we should do to optimize, people will still often pursue the reasonable thing. So I think but in that lies the dichotomy, right? It's understanding what is rational and maybe what is optimal. And what is reasonable, and just being able to go back and forth on that and have that conversation, not only with a trusted advisor, but with yourself, to really be able to see, well, I'm feeling this way, but I also should be able to see the other side and the trade-offs. And
so kind of a psychological type mindset. Like, I mean, we're all raised a certain way, and we probably have certain financial, guidelines, guardrails, strategies, et cetera, and I think a lot of us have been conditioned to be debt free as much as we can. But doesn't that also, in some cases, hurt the balance sheet?
Yeah, it absolutely can. I think, to your point, the tunnel vision of being so scared of debt and having such a adverse reaction to it does create an incentive to maybe accelerate that payoff at the expense of other things that you should be doing. And that is very typical. I keep referencing this new book that came out last year by a friend of mine, Carl Richards. It's called Your Money. And Carl does a brilliant job of putting a sketch. It's something you could just visualize and sharing a few things about it. And that is just human nature. We are so conditioned by the family situation we grew up in, the educational experience, the work experiences, interpersonal relationships, that definitely paints a picture that we end up following
Hmm.
that ultimately it has blind spots usually. Almost all of us have those blind spots for sure.
Absolutely. Absolutely. I remember I'm a Gen Xer. So, our generation, we don't necessarily have like the guaranteed pensions that the previous generation had. And so I remember my dad was picking me up from my babysitter when I was young, and we got in the car, and we didn't talk that much. It was kind of just the way dads and sons had conversations back then. But I remember him saying, yeah, there's this new thing at work and it's called the 401k. And he kind of explained it to me. And I was like, huh, that seems kind of interesting, because I was partly interested in just kind of the finance piece, but it just made kind of sense. But again, like you say, it's how we're kind of brought up and we're raised and what we're educated on and not educated on. And I think that kind of determines when you get to that, adulting phase and now you have a house, maybe the best thing that, or the only thing that you know what to do is to just pay it off. And it's not to say that that's the wrong thing. It just might be sit down with an expert and maybe kind of discuss other strategies to support that.
Yeah, just to understand what the pros, the cons, the trade-offs, and be able to make a more rational decision versus a more emotional one. You and I are old, but we're not old enough to remember what it took to buy a house in the late 70s. What were
Right.
mortgage rates? 18, 19%?
Sure. A lot higher than they are today.
I think it's pretty safe to say that would be a wise decision to pay off an 18%, regardless of the tax benefits of
Right.
interest deductibility and the like. But obviously, what we have now is a generation of people who are pretty lucky to have 3% mortgages, and that's a
Hmm.
totally different calculus.
It is. It is. And now home prices are a lot more expensive. So, take that in consideration. But you're absolutely right. Like, would it make sense to pay off an 18% mortgage interest rate? Absolutely. To get rid of it, to not continue to absorb so much of that interest. I know that this stat has been out for quite some time, so I'm not sure of its current accuracy, but I think it was at one point those who are retired, so we'll call that 65 and above, between 60 to 80%. I think at one point it was even as high as 85%. The majority of their net worth was in their home. So all that equity that was sitting either idle and so forth. Do you hear that same stat? Is that kind of the same, thing that you either hear and or see with your clients?
Yeah, it kind of intuitively makes sense because as we always say with the mortgage, it's for savings, right? And
Hmm.
so if you just happen to stay in the house for a long time and you're forced to pay off that mortgage, we're not forced to save in our retirement account. I mean, sometimes you get opted in or, auto enrolled, I should say now, but you got to pay your mortgage. And if you stay in your house and you pay your mortgage, next thing you know, you own something and it is your biggest asset. It's very common.
Yeah. Good point. Good point. Because you're right. Like 401ks and anything that, you know, you're able to put money in, whether it's tax deferred, et cetera, but it's something that you have to do. Whereas a mortgage payment does have interest as well as principal. So it is that forced savings that eventually you do get back. It just depends on how it can be structured down the road for you. So good point. Good point.
Mhm.
So I think the point here is just that it's not to say that having a free and clear house is a wrong thing to have or a goal for, but make sure that you're looking at that idle equity that sits there, and is there a better return on investment elsewhere than just the equity that sits idle for you? Would you agree?
Absolutely. And this is where I dive into, is a primary residence an asset or an investment? And I hear so many people say your home is your greatest investment. And I think they're conflating the two. Home can be a great asset of which to tap liquidity through a refinance, a HELOC, a reverse mortgage. Like those are all great, but it's not an investment. A personal residence, I feel strongly about it, is not an investment. It costs
Yeah.
you money to
Yep.
live in your house.
Yep.
An investment, you try to get a return on. An investment is paying you money. So that I think we always got to make that definition strong and clear because I think people mistake the two.
Mhm. Couldn't agree more. And I think that's where that stat of, 80, 85% of one's net worth is in their home. Well, maybe you can flip that and say, 20 to 15 to 20% is what a person really has an equity, because like you say, primary residence is not necessarily an asset. Yes, it does grow and it does give you opportunity down the road perhaps, but you've got deferred maintenance, you've got property tax, homeowners insurance, so many other things that takes money away from you to be living in there. Now, that's where you raise families and all the good memories and so forth. So again, it's not to say that owning a residence or single family real estate in general isn't a bad thing, but good point. You got to maybe adjust your thinking that, okay, this is a place I live. Now let's go and create wealth with other opportunities and assets, vehicles.
Yeah, and you do that often through smart debt management. I mean, there's, as we always say,
Mm,
there's good and bad debt. And
mm-hmm.
a reasonable interest rate on a mortgage, I think, is almost always considered good debt if it's giving you the stability and the memories and the place to raise a family. Like, I think that's a reasonable use of debt. Yeah.
Yeah, yeah, yeah. Okay, so I think we're in agreement with that. Still a good thing to maybe consider, have it free and clear, but there could be some alternatives to consider. So let's kind of make this concrete to our listeners. If, let's say, someone purchased a home 2010, 2012, something like that, and here we are, fast forward, they are now in their late 50s, they've paid it off. Let's say that house is now worth, say, $850,000. So they feel prepared, or they feel ready for retirement, or at least knowing that they've got that in kind of their back pocket, so to speak. They feel good. But Pete, when they come to you, what questions do you feel like they're just not asking themselves right now when they feel like that?
The biggest thing is all the what ifs. So, what if XYZ happens? What if I, have a medical emergency? What if I unfortunately pass away? What if I lose my job? I mean, I think so many of these conversations are really painful to have, and we don't want to
Hmm.
have them because it makes us face what could go wrong and what might be uncomfortable. But I think that's the number one thing is we all plan, we make these plans. And what is that saying? We make plans and then God laughs. I mean, like that's the biggest thing I see is that people get a home paid off and they're like, all right, I'm debt free
I'm
now and
done.
I should be good. But you probably haven't investigated all the different what ifs of what that may cost you. And as we say, Denver has seen this great appreciation in homes, but that yield on that appreciation is still zero. And you can own that home free and clear and it can go up 10%, but it just yielded you zero. So
Uh-huh.
uh,
Yep. Yielded meaning that it's not helping you today. You're having to
correct. It did not produce
wait.
any cash flow by which you
Hmm.
could take a vacation or,
Yeah.
do
Yeah.
anything with that money.
Yeah. Yeah. Well, and I think too, like you said, you just said some things about, healthcare, long-term care. Okay, so let's say you have a portfolio and sequence of risk return kind of happens at the beginning of your retirement and you're having to kind of withdraw, and you might not be able to recover as much as if you had some liquidity, i.e. some equity from the house to pull from
Yep.
and kind of
Yep.
absorb that, if you will, for a period of time. So I think it's just that liquidity piece that you might be sitting on $850,000, but the only way that you can get access to it is, like you say, HELOC, refi, reverse mortgage, something to that effect. And that all requires getting qualified, making sure that you can still qualify for the new mortgage when you're retired. Sometimes
Yep.
that can be a challenge.
Yeah, exactly. Or you lose your job. You get debt free and then you lose your job and then you go to tap that equity and the bank says, we can't lend you money. You don't show us the ability to repay.
Yeah.
So
You, you,
yeah,
you
those
need a
are all
job
things
to
that
pay
we
it
have
back.
to right. I think with any of this, it's just having a balanced perspective and knowing that the stock market has been great the last few years. We all know it won't continue. We all hear these horror stories of people that sold out in '08 or '01. You're absolutely right that having a HELOC or the ability to get access to that equity, even if it costs you interest, is still going to be a better option than selling off your stock portfolio when it's down 30%.
Hmm.
I always talk about taking a bucket approach to all of this. We talk about cash bond stocks, but you should look the same at your home equity, the same at your business. I mean, any asset, being able to understand the dynamics of the timing of it, the liquidity of it, the cost of maintaining, all those things that go into a total picture, not just your what percentages in stocks or bonds.
Yeah. And when you were saying that, it made me think of several conversations over the years of me doing this is, if you do a refi and you save two, three, $400, whatever that amount is. And, some strategy can be, hey, if you continue to make the same payment, but at the lower interest rate, all that money is going to principal. And people love that, right? Or taking that money and putting it into an investment. People like to hear that as well. But Pete, the reality is that people don't necessarily do that. I mean, if they see a savings of a couple $100s on a monthly basis, it's not like all of a sudden they're going to change their habit and start to put that money into these other opportunities, these investments. They tend to just, unfortunately, just kind of keep it and spend it. And that's not everybody. I'm not necessarily saying that that's always the case. So getting back to, okay, I've been making this additional principal. I've actually been able to pay off the house in 20 years, not 20, or 20 years, not 30. So, okay, now I've got all this money and stuff that I can, put into investments and stuff. Do you see that? Like if a client came to you and said, I'm completely free and clear, I got an extra $2, 3, $4,000. Here you go, Pete. Do you see that as a habit that people are doing or not so much?
There are always people that are going to do that, but I think you're right that the majority will just spend it. That is human nature, is to,
Yeah.
if we have the money, we spend it. So
Right.
I think, paying off early, you talk about taking that 30-year to, is it, you can cut off like 7 or 8 years by making 13 payments a year instead of 12. So like, great if you want to do that, as long as you're also compounding on the saving and the investment side.
Yeah.
If doubling up, or I'm sorry, adding another monthly payment once a year doesn't give you the ability to keep saving at a really good pace, then that's probably not the right decision, especially if your
The right
mortgage is
decision.
3%.
Yeah. So many people are still in that 4% bucket, if you will, on the reverse or on the mortgages themselves. All right, cool. Last question here is, so for those listeners who either are close to paying off their mortgage or have completely eliminated it, what kind of conversation should they be having with a person like yourself, a wealth advisor? And, you know, they walk in thinking, but they walk out now knowing. What is that? What kind of picture is that for you?
Really being clear again of optionality, of trade-offs, of what ifs. I know I've probably said that over and over. It's because I believe in it so strongly. There's no one perfect answer, but
Hmm.
it is being able to sleep well at night, knowing that you've investigated options, you know what, those are, and you're making hopefully more of a rational decision than an emotional one.
Hmm. Hmm.
And that you
Take the
just have
emotions
that
out.
you're very clear. Yeah, try to remove the emotion as much as possible. We can't eliminate
Yeah.
it completely, but we can, I think, by having conversations with real humans like you or me or somebody's CPA, or just, again, they might not convince you that the rational way is the exact route that you're going to take, but I think being open-minded to what others are saying is always a healthy
Yeah.
an approach.
Yeah. I agree. I think the more open-minded we can be, I think we don't have to agree with everybody, but I think, we've kind of cocooned ourselves into these just small little environments, these places where we just are not willing to kind of allow ourselves to listen to some other options. Not to say that we would do it, but if one could approach sitting down with you and saying, okay, just let me have it. Tell me everything that I should be thinking about. And then I'll go home and think about this and make sure that it fits with me and who I am and so forth. But I think it's media tends to do such a poor job sometimes on telling everybody to get this thing paid off in full. And then, I would be curious, run a survey and say, okay, of these 1,000 people that have paid off their house and they're now free and clear, was it the best decision? I'm just curious if that percentage would still be considered high. No, I don't know. But like
Mhm.
there's other options that I think people can consider. And I heard you say balance, and I think that's really something that people should take away from this is paying off your house completely and having that big asset sit there idle is not to say that it's bad, but make sure that you're balanced in other areas, whether it's in bonds or equities or a combination of it, because that's ultimately what's going to assist you in your retirement years, not so much the house unless it's maybe a reverse mortgage or something like that.
Yeah, I had a client recently who did this. We had the conversation. I think their mortgage was 2.5%, and he had a liquidity event. He sold business, and we talked about it. And he said, I know that I can optimize, through my retirement accounts and other ways to actually out yield my mortgage rate, but I really want to be debt free.
Yeah.
I'm like, I totally get it. I totally get it. That's how a lot of people feel. And I'm totally giving you permission to do it because you have the right assets over here. you have the right plan in place, you have the right perspective on what you need to bring in, what your spending's going to be. And ultimately, if the market goes bad, you're going to be okay because it wasn't like 80% of his net worth was in the house now. It was more like eight.
Yeah.
So
Yeah. Yeah. Yeah.
if you're in such a strong position, even though you're carrying that low interest rate, he was like, yeah, I just really like the idea of being a debt free. Well, you should pursue that then.
Yeah.
But I don't know if I'd say that to somebody who has 90% of their net worth in their house.
Yeah. Yeah.
So
It might be
yeah,
a different conversation. And I think that's just everybody's situation is going to be different that we speak to. But I just love how,
100%.
like you said, you gave permission to him, not to say that he needed it, but again, sometimes we just need to have that other, voice of reason or what it is that I should be potentially thinking of. Am I missing something and so forth? And I love that because you were saying, hey, you're right. Let's go get debt free at the house because you're sitting pretty on all the other things that you chose to do while you had the opportunity to do it in your working years. So that's awesome. Well, Pete, this has
Yeah.
been a great anything that we missed or that you wanted to touch base on just before we wrap this up?
Yeah, I always end with, just balance approach, be curious. I think oftentimes you're right. We get
Yeah.
siloed. We feel so strongly that the opinions we hold are the right ones. And I always find the best approach is to almost be ignorant and ask a lot of questions and to get more and more curious. Even the stronger the opinion is, I think the more likely it is that you need to ask more questions and get more curious.
Yeah.
So that's how I would
I
end it.
I love that. Absolutely right. I think we feel like we're such experts in so many areas because of internet and AI and various things, but the reality is that we're not. We might be in a few areas, and like you say, that curiosity I think can actually really help people understand, learn future, or increase their education on things that they may otherwise don't really know anything about. So I love that piece that you said there. Well, Pete, this has been such a good conversation. I hope our listeners have gotten some good information from it. Before I go, Pete, what's the best way one can actually get a hold of you? Is it just going to website or what's that
Yeah,
path?
email's probably the best. Pete at aspenleafllc.com. Again, it's Pete at aspenleafllc.com. I hate email as much as the next one, but I always respond.
Yep.
You can always go to
Yep.
our website too, which is aspenleafllc.com. So,
Okay. And both of
well,
that will
thanks,
be in the
Neil.
show notes. Yeah. Yeah. I'm glad. Like I said, I just love bringing that local expert to the stage and just allowing you to kind of you know help answer these questions because this is what our listeners want to know more about, making sure that they're making the right decisions. All of what Pete just said is going to be in the show notes, so feel free to take a look at that. If you've enjoyed this and don't want to miss any future episodes, go ahead and hit the subscribe button, and if you thought this one was good, give us a thumbs up. But hey, in the meantime, you guys keep having a great day. And the next one, I'll give you a little teaser, is going to be discussing are buyers wanting to move into a home that doesn't require any type of fix up or deferred maintenance projects and so forth, or are they comfortable finding that fixer upper and perhaps increasing their overall net worth from an equity position with having to do some of the work on their own. So I'll leave it at that. But everybody have a great rest of your day, good week, and we look forward to speaking to you guys soon. Take care.
great. Thanks.